In this video, we're going to talk about everything moving averages. So, quick overview. We're going to talk about the different types of moving averages, determining trends with moving averages, when plus how to use moving averages, and two in-depth advanced moving average trading strategies that I personally use and I think are really effective. So, getting straight into it, moving averages use. So, moving averages are used for identifying trends and confirming reversals. They're good for identifying areas of support and resistance. They help find average value of price. Sometimes it helps having a moving average to kind of reduce that noise and fluctuation, depending obviously which length of a moving average you use. Keynote moving averages are based on past prices and is a lagging indicator. Always remember, moving averages are a lagging indicator. Like, always put price action and market structure before anything else. I think moving averages are probably, in my opinion, most effective indicator, but at the end of the day, they are still indicators, and you should always put price action before that. So, the three main types of moving averages, we have simple, so the SMA, weighted, WMA, and exponential EMA. Probably the two most common are SMA and EMA. I don't think many people use the weighted one, but we'll go over it anyway. So, taking a look at SMA. So, the simple moving average is generally used for longer term trading. It gives equal weight to each day and responds slower to rapid price change. The longer the SMA period, more lag and slower to react. So generally, when you're trading, you'd use probably a 150 or 200 period SMA, and that would generally give you the kind of long-term trend of the market. And I think it acts as a key level of support and resistance. Even within this chart, you can see that price tested it multiple times and just ends up coming down, eventually breaking through, retesting, and heading back up. So it is slower to rapid price change. So the good thing about that is there's less chance of you kind of getting prone to like fake outs. So if we take a look at the weighted and exponential, it's for shorter term trading. It gives more weight on recent period than older periods. Emphasis on what traders are doing at the moment. It reflects quicker shift in sentiment. Now, it does seem that emphasis on what traders are doing at the moment, that EMA would be better, but it does lead to a lot of fake outs. So sometimes you could have, let's just say, moving average of an EMA kind of really like all over the place, whereas an SMA would be a lot more smooth. And these fakes can sometimes, cause issues when you're trading. It could lead to a fake out or an entry that maybe you shouldn't have or exiting a trade. So you just have to take that into consideration when choosing one. But generally, people tend to have an SMA along with an exponential moving average as well to really give that balance. So moving averages, choosing time period. So yeah, generally a 10 to 20 moving average is for short-term trends, 50 to 100 mid-term trends, and 150 to 200 long-term trends. So quick, just EMA versus SMA. Exponential moving averages are for short time frames. For fast-moving markets, they have less lag but are prone to fake outs. SMA, if you're holding a position for a longer period of time, and if you're swing trading and all that, filter out noise of price fluctuations. More lag eliminates fake out. So I think it's rather than choosing one over the other, I think it's best to have, I think, a long-term SMA and a short-term EMA. But yeah, moving averages tips. When price is above the moving average, it shows signs of strength when trading trending markets. Because obviously, sometimes you can have markets that can be really kind of, choppy. So then the moving average is kind of like, in between all this noise and consolidation. So it's kind of hard to really see the trend. Further prices away from moving average, more it is overextended and look to pull back. Now, moving average, I think, is sometimes a really good indicator to show whether if a price is overextended or not. Because uh, generally, when you're trading with a moving average, so if the price is, let's just say, in a trending market like this, generally, the moving average would tend to stick close and kind of follow this trend. But sometimes what can happen is price could start going up and really shoot up like this. And what happens is the moving average then kind of stays like this. And you can see that there's such a wide distance. Compare that to over here where they're so close. You can see that there's a huge gap between a price and the moving average, and that could indicate that price could potentially isn't like due for a pullback. So you wouldn't want to be going long at this position because it's so far away from the moving average. Now, the 200 MA helps to trade the trend, as I mentioned before. The 150 or the 200 simple moving average really shows the overall trend of which way price is headed. If price is respecting the moving average, you can use it to trail stop loss, i.e. close below. So in a trending market, the moving average tends to, as I said, kind of just follow this price. And a lot of times, if you take a look back at the previous slide here, at this point, we can see that price is respecting the EMA, and every time it reaches down below, heads back up. It's a key level of support. So, if in turn, if you're trading a trending market like this, and price is seemingly respecting the moving average, you might, hypothetically, let's just say you buy there, you might not close out of the trade until price really closes below this moving average, until we see a red bearish candle form and close below this moving average. You might just trail stops, and sometimes what can happen is, in rare circumstances, that price can just keep going up and up and up, and you be holding this for a long period of time, and you can gain like a huge risk to reward ratio on certain trades like that. Obviously, it doesn't always play out like that, but there is that kind of potential for a really like 100 bagger almost. So make sure to put price action slash market structure before moving averages. As I mentioned before, moving averages are an indicator. It's a lagging indicator. So at the end of the day, you always have to put the price above that. So always just keep that in mind. So moving average trading strategy. So this is a strategy that I got off Wide Trade. Like I think they make probably the best top quality trading videos, and this strategy is off him, and I think it's absolutely phenomenal. So the way it works is it's a trend following strategy using moving averages. So the time frame we're using is the daily and 4 hour chart. So we're swing trading, so we're going to be holding this for a few days. So first we establish establish an uptrend. So in this case, it's going to be a long example. Obviously, the same goes for if you're going short, you just reverse this. So hypothetically, let's say we're going long. We establish the uptrend using the 200 moving average. We identify a resistance that turned into a support. So we can see down here that this is my awful drawing, so bear with me. We can see here that this level here acted as support multiple times until it was broken, retested. As price came down, eventually we can see it's reacting again at this level and then ended up breaking out and coming down and retesting that same level, resistance turned support. So that's what I mean, resistance turned support. Identify area of confluence as support lines up with the 50 EMA. So right here we can see that not only is price at a previous resistance turned support, we can also see that the 50 EMA is also in line right here. Now, to make this even stronger, what you can do is if you had also a trend line here like this, you can see you can connect that. Obviously my line is not straight, but you can see that you have a support uh, horizontal line, you have a trend line, and you have a 50 EMA. So this point here is very strong. And that's what confluence trading is, having multiple areas of values, seeing price react at that level, and then eventually move in the given direction. So we're looking to see price action form as price reaches that area. So when price reaches this point of confluence, we want to see price reacting at that level. We want to see that, like, okay, it's producing long wicks or certain uh, candlestick patterns. For example, I have here a hammer pattern, which is just, if you don't know, it just looks like this, like a long wick. This long wick would indicate that there is immense buying pressure at this level, and it could mean that price is heading up in that direction. So put a trend line resistance on the immediate downtrend. That's this purple line here. So as we see, let's go over it. Previous resistance turns support as price reaches that area of confluence with a trend line at 50 EMA. We see then price react at that level. And as soon as we see a reaction at that level, we want to draw a tight trend line right here. And then we want to look for long entries on 4 hour with close above the trend line on a lower time frame. So once we put that trend line into place, we want to go down to the 4 hour time frame and then look to see long entries as price closes above this trend line. So if we shift down to the 4 hour time frame, we'll see candles, bullish candles closing above this trend line. As soon as we see that, we see the momentum coming into play. You could put your entry right here, stop loss somewhere below this low, this point of confluence, and then profit target somewhere up here for a nice risk to reward ratio. So this strategy right here, I think, is really good. I personally back tested it, and it does seem favorable. Now, obviously, there are different market conditions. I back tested this on Forex, but obviously you can use the strategy for, trading crypto or stocks or commodities or whatever it is. I think you should always do your own back testing before you trade, obviously. So yeah, further tips on this strategy. So we want that support acted as previous resistance. So see how this level was tested. One, two, three times before breaking out and finally retesting that level. That shows give more significance to that level essentially. So we want it to be recently touched. So this was recently enough touched um, before coming down back to that level. Multiple reactions at that level. So we can have multiple candlesticks, really kind of long wick candles show, or even like indecision doji candles like this form. At that level, we can see that price is reacting. At least two out of three areas of values are price. So areas of values are like your trend line, your EMA, your support resistance. You can count, I think, Fibonacci as well. Like if it's coming back to a 68% level, like that could be a really strong indicator that price could bounce off that level. Some things that you could do that I personally use in my trading, I take partial profit at 1:1. So if my entry is, let's just say here, my stop loss is here. So I take some profit at a 1:1 or. So the distance between my stop loss and my profit target is essentially equal. So once price, let's say I bought here, when price comes up at this level, I'll take maybe half of my positioning off, then move my stop loss to break even, and then this trail stops from there. So essentially what I'm doing is taking off my risk. I'm taking some profit anyway, so even if once I move my stop loss to my entry point, even if price does then come down, I still took some profit, but I'm also giving it room to really run. And if it is one of those trades where the market just trends and trends in my favor, I can gain a huge ROI. Also, max 1 to 3% per trade. Even 3 I think is a bit much. I think for most people 1 is plenty. Risking 1% of your account per trade I think is ideal. So on to the next strategy. This is a reversal strategy now. I don't personally trade reversals, but I think this strategy is effective as well. And if you do your own back testing, I think it could really um, help you. So we establish daily uptrend. So once we establish that, we're looking for a break of the trend line, 58 EMA indicating a possible trend change. So the longer term trend is up. And then we have this long-term trend line here, and we can see that price is clearly respecting that trend line, going up until eventually we see that price breaks below this trend line and price breaks below this 50 EMA as well, this kind of red line here. Then price made a lower low, which is this level here. It broke below this last point of defense and created a lower low. Price is reacting at the key resistance. So then price comes up, reacts at this previous support turned resistance. And once again, we want to see reaction, we want to see wicks, we want to see some form of candlestick pattern form to show that there's selling pressure within this market at the moment. We identify the point of confluence, so we can see that we have the support turned resistance and we have the 50 EMA here as well, acting as resistance. So we have 2 out of 3 areas of values. Once again, you could use a Fibonacci as well. After that, draw a tight trend line upwards. So tight trend line here. And just like the previous strategy, we want to see go down to the lower time frame as price breaks and a close below trend line on lower time frame. So we want to go down to the 4-hour time frame and look for a close below this trend line here. And once we see that close, we can look for short opportunities. We can put our entry somewhere here, As soon as we see the break, stop loss somewhere here, and again, profit target somewhere down there for a nice 2-to-1 risk to reward ratio, or if you want to trail stops, or however your exiting strategy is. So this is another reversal strategy using moving average. I personally don't do reversal trading. I prefer just going long, trading with the trend, but everyone has their preferences. And sometimes reversal trading really can be effective. Essentially, you can, if you catch the start of a new long-term trend, you can earn a lot. So there are pros and cons to everything. So I hope you learned something from this video. Yeah,